This TFMR podcast is brought to you by your friends at JM Bullion. Visit jmbullion.com for all your gold and silver bullion needs. Here's those volume spike I was telling you about. I showed you this morning. Again, little bit of, see that little green bars at 7 o'clock last night? That's 7 o'clock Central. That's your Asia Open. Okay, 8 o'clock Eastern, 7 o'clock Central. You get a nice little pump of volume and you get a nice little pop in price, $5, $10. Okay? And rally into right around when London begins to open. And then here comes a selling immediately. And then this massive volume. 8,000 contracts, 4,000 contracts, 4,000 contracts, 10,000 contracts. Absolutely crushed price. Why? Who was suddenly, oh yeah, the dollar is moving. And now suddenly you just got to absolutely know. This is manipulation 101. Just give it a shove, completely wipe out all of the bids, and you just get these air pocket. Boom, boom, boom. My goodness. And you can see it in silver too. Again, a bigger green spike at the Asia Open at 7 o'clock. Again, similar to what we talked about this last week. This is kind of how it worked in July and August last year. Get this massive rush of Asia buying because of how how positive the technical picture is. Okay? Well, we can't have that. We can't have silver go from 26.20 to 27.60 during the Asia session. No. So it immediately, once its focus shifts to London, sell. And again, the biggest wipeouts of the day in terms of volume come in London and right before the COMEX Open. So where are we going to look for a trade? Where are we going to look for a low? We're going to look for a bottom. Because I think we're going to rally after Christmas, and I think January, again, last 7 Januaries have all been green, averaging 4.8%. So I'm looking for a dip to buy. Okay? Yeah, I know I've said that before. I missed the one at 1780 2 weeks ago. I'm still mad about it. Where's that dip? Where am I looking? Okay, well, time to get specific about this. We've danced around about it for a couple of days. Time to get specific. Gold on the daily chart. You can see for yourself. You know how important 1860 is. It was resistance in July, blasted through there and went all the way to 2100. It then was support from September through all the way to November 23rd when it was crushed. Remember that? I mean, that is definitely the low. I have no doubt in my mind that deliberate wipeout around the December expirations was the low of this consolidation phase. So we're now moving higher. Clearly, I mean, they got it right below the 50-day. You know how important the banks feel about that. We just talked about this yesterday, that massive reversal on the 9th of November to get it back below. And they weren't able to do it yesterday, but they were able to do it today. Again, due to the absence of any traders. Just run the dollar up and let the computers take over. But I think we bounce from 1860. I think that's a very important, maybe a little bit low there. Maybe even dip. If the dollar runs up to 91, maybe 1855 or something like that. But I want to finish this week, by the time we're done on Thursday, back above 1860 and maybe even back making a run back toward the 50-day, which by Thursday will be around 1875 or even lower. Okay? And then we'll see where we go next week, the last week of the year. If you look really closely on the 1-month chart, off of that bullshit low, when the December contracts were going off the board and they were trying to flush as many people as possible from standing, depends on where you want to draw this line, but I drew this line off of those lows in November 29th through that low, that spike low on the 14th, right after the Fed, okay? Or maybe that's not quite right. No, that's not quite right. That's not the Fed. That was last Monday morning. Anyway, somewhere around here is that line. If you want to move it up a little bit, that brings it closer to 1860. But again, you know how important 1860 is. I think we bounce from there. I think we bounce from this line. So for me, I'll be curious tomorrow to see if I got an opportunity to maybe take some kind of position with price near 1860 or even just below. So when I found this on Twitter, I thought I should show this to you because this is a long-term correlation going back, 5 years, though I know you can take it back farther than this, of the M2 money supply as a blue line growing and the gold price pretty much tracking with it. Now, it's not, the blue line, M2 just grows at a steady pace. That's just the Fed constantly increasing the money supply, growing economy, trying to grow inflation, all that kind of stuff, right? So that's logical. And the gold price kind of fluctuating around it. It's not a tick for tick thing like real interest rates, where the correlation is 95% and they go up and down together on a daily, weekly, monthly basis. What you're seeing here in this M2 chart, the M2 line, the blue line, is just this gradual increase, which again, you'd understand and expect until it just explodes back in March when the Fed just put pedal to the metal trying to save everything. And then, obviously, for more reasons than just M2, gold explodes as well from March through August into even September. But again, why I'm showing you this chart is just another reason why gold's going to play catch up in the first half of next year at some point. I know I've been saying that now for 100 days, and the trend of gold not playing catch up has continued, but it won't go on it just won't. It won't. The bank can beat back price, do what they did Monday to try to control sentiment, get price back down to the 50-day, and try to keep this from happening because of all the shorts they've got on. But they won't be able to keep it going forever. These are long-term relationships. Whether it's gold with M2 money supplies you see in this tweet from this Goggin fellow, or it's gold versus real interest rates, as we just talked about again yesterday. Okay? And again, you should recognize in this chart a similarity to gold with TIP, right? That we keep showing you. And again, just yesterday, I think, right? TIP indicating new all-time closing high yesterday, and TIP only down 5 cents today, so it's still up there, indicating a price closer to 2,100. Well, guess what? Mr. Goggin here, whoever he is, also thinks that if you just oscillate back up to the blue M2 line, you're at 2,100. So why wouldn't you think, again, eventually in the first 6 months of next year, we're going to catch back up and we're probably going to overshoot it again. Just like we did the last couple of years. Go flying up there, well above where this line will be by then, 2,200, probably make it to 24 before having a similar kind of consolidation. Well, anyway, if you think that's right, and I think that's right, then there's positioning you need to be making now ahead of this next big surge. Figuring in your head, okay, we already know the miners are trading at 5 times earnings or 10 times earnings, and nobody seems to care, right, obviously. So maybe they'll go to 3 times earnings as gold goes to 2,400. And maybe they will. Maybe they will. But probably not. There will be another surge of interest in the shares, and maybe it'll even be greater than it was earlier this year. But anyways, you've got to factor all these things together. And if you think that these long-term correlations, whether it is gold kind of gradually tracking M2, as you see in this tweet, or whether it's gold with long-term real interest rates, whatever it is, then this consolidation this year, this hammering, this pressing lower, repeatedly pressing lower by the banks, trying to restrain. I mean, the beach ball or pressing on a string, metaphor works. They're doing everything they can to hold it back, and they just won't be able to forever. And then we'll surge higher again, and then they'll play defense, and they'll force us back again. That's just how it will work. But we will, again, it's just another bit of evidence of why I think this, another good year is coming. Keep trying to make all these different ways of pointing that out. So finally, I thought I would show you this because I mentioned this chart several times this week, actually several times this month. Again, the end of the bear market and the washout in the shares occurred in December of 15 and then early in 2016. It was January 19th, 2016. I remember it like it was yesterday, that we got smoked in one day for a good, 5 points or something. It was ugly. Again, that's like 5%. And the printed low in the Hui was 99.19. And everybody everywhere was freaking out. And now I remember seeing forecasts of like 60 in the Hui. But what people didn't know is that the bear market had ended. And the shares went like crazy. And the Hui went from 100 to 280 or whatever, and then pulled back. And then it ended up not being much fun because of the way it pulled back. And then went sideways. But anyway, I had no sense going through all that. My point in showing you this chart and ending with this chart is I keep mentioning how once you get the tax loss selling behind you, mainly in Canada, that then you usually get a rally. See the blue arrows? That is the end of, or maybe the full month of December, each of the last 4 years. I'm not counting to 15 because 15 was a mess. It was the end of everything. But even after the massive pullback in 16, look at the rally in the GDX that began with 2 weeks to go in the year. And it went from about 19 ultimately up to 26. The end of 2017, look at the rally in the GDX. There was 5 green candles in a row going from, 21 up to 25, 24. Look at the end of 2018. Now we've been rallying at the end of the year, but look at all the green candles again at the end of the year. There are a couple red candles to start the year of 19 and then rally again. And then look at last year. Again, big green candle last couple of weeks of the year. Okay? So, what if we put on, again, another couple of really nice green candles to end this year and start next year? Typically, that's what's happened. Would we break out of the flag on this chart? And if we break out of the flag on this chart, and then you get the metals to rally in January, and then you get the anticipation of earnings again, you can see where we'd have a pretty good month. So that should set you up and get your mind right for next week.